Hey folks, Alex here, 95 to Freedom. In today's video, we're going to cover how I lowered the risk of my portfolio, give an update on what moves I've made, talk about what's going on in the market. Hey, I'm finally done with my bathroom remodel, and there's me in that thumbnail photo, so I hope you like that. I was able to sponsor the whole construction utilizing my high yield dividend account. If you're new to this channel, I am able to live out of my brokerage account using Robinhood, using margin, using high yield dividend ETFs from Roundhill, Neos, YieldMax, and others. So if you like that kind of content, make sure you stick around. Folks, let's get started. Lots to cover today. I'm trying to make it brief, and let's get right into it. Okay, so first off, we're going to show you what's going on in the markets as always. And the markets have been pretty green. You know, the government shut down last week, and in my humble opinion, maybe they should continue to be shut down. Look at this. S&P 500 is in the green. NASDAQ in the green. Russell in the green. Gold in the green. The VIX index is down. So if anybody noticed, AMD shot through the roof today. It was up like 25%. At market open. Really great performer. I have some AMD stock in my IRA, which is pretty cool, but if anybody had AMD on the cheap, congratulations to you. So that was pretty cool. And let's talk about the portfolio. So those folks who are new, this is my Robinhood account. Right now I'm sitting at $248,000 and $600 looks like it. We are up today, $3,300, and we're still going up in the after hours. Okay, so let's talk about what did I do today, what changed with my portfolio. Well, really, if you have seen my previous couple of videos, I've been talking about how do I de-risk my portfolio. I've had pretty much dollar for dollar on margin. So for every dollar I had in this portfolio, I borrowed $1 from Robinhood. Now, Robinhood has the lowest margin interest, which is floating around like 5%. Depends how much margin you use. But today, and by the way, if you're looking to switch over to Robinhood, there's lots of perks. I cover all the things that I like about Robinhood. I'll have my referral link in the description below. If you use that, you and I get a free share of stock. It costs absolutely nothing. That's a way to help support this channel. But look at this, folks. My margin use is down to only $125,000. So I lowered my risk quite a bit, and I decided to do it on a nice green day. Really, you don't want to lower your margin on a red day. You don't want to take losses. So what I did, I took advantage of it. Now, can the market continue to go up for the rest of this week or the rest of the month? Sure it can. But considering how long of a stretch I've risked holding so much margin, and I don't advise this to anybody. I had a high risk tolerance. I have other investments outside of this portfolio, so I'm able to really be a little bit more on the risky side. But I really wanted to fund my remodel and be able to pay for it using this account and at the same time pay my bills. Now, if you're new to this concept, basically all of my income comes into this Robinhood account. Basically, I have my paycheck connected to it. If you go into like your account details, it'll give you the routing number, it'll give you the account number. You can do a direct deposit from your employer, and then you can hook up all of your bills and everything that you use. You know, your electric bill, your gas bill, your credit card bill, whatever bills you have, you can pay right directly out of your brokerage account. So basically, you can avoid even using a bank. Now, why would I do that? The reason for it is I'm able to capitalize on the low interest margin, right? So think about it this way. All of my money is coming into this account. My dividends, which are making me over 30% a year, and they're paying me on a weekly basis, they're able to pay down my margin. So basically, I'm living on margin. So any bills that need to be paid, they're being paid by that 5%, and everything's getting stacked as time goes by. So I'm able to basically leverage the low interest rate and arbitrage this account. So while I'm paying 5% on my interest, my dividends are making me over 30%. Now, we're in an extreme bull market Obviously, and I'm not trying to like, overhype this. This isn't some pyramid scheme or anything like that. We're in a very bullish market, folks. So in a market like this works extremely well. In a down market, obviously, you will have a little bit more trouble, but we are really looking to tune this portfolio to diversify across different assets. So I have S&P 500, I have NASDAQ, I have some Bitcoin. I got into some gold positions. I really want to build that up. But basically, if I'm able to spread all that out across the different indexes, I'm able to reduce my risk tolerance to a specific sector. So that's really what's going on here. Now, this morning, I withdrew another $5,000. So if I didn't do that, this account would be floating around like $253,000. Okay. And the other thing that I did is I calculated how much I withdrew from this account since really August. And if you go back to my video, this was from August 23rd. I was actually on a camping trip and I recorded this video. It was titled How to Make Over $100,000 in Dividends a Year. You can see my portfolio was at almost $256,000. Now right now I'm sitting, about, I don't know, $8,000 less, right? And really what I'm looking to do is decrease my risk tolerance, because back then I had all of this, all this account was really made up of, what I had on margin plus what I had in my own money. And like I said, that was dollar for dollar. So I was able to withdraw about $28,000 from this account since mid-August, really tail end of August. And we are really in the first week of October. So that was quite a bit. Now, we did have a huge bull run. Obviously, I'll attribute it to that. But really, these dividends were paying out really great. I've had lots of good performance from them. So I want to take my profits, and I don't want to get too greedy. One of the things that I'm learning about myself is sometimes I get a little greedy and then I lose out on the gain. So this is where, greed and fear index, you really got to learn your weaknesses around that. So what did I do today? Well, today I did some calculations. I looked at really just some of the indexes from Roundhill, from NEOS, compared it to, for example, like XDT versus SPY versus SPY. Really wanted to get an idea of how much of increase, decrease we had, how much I was getting in dividends. So I did a lot of analysis. It really came down to, folks, I really enjoy my NEOS funds, okay? I really like them. The QQQI, the SPY, they don't pay as much, but they have a little bit more growth. They're able to stabilize the portfolio. But right now, in this point in my life, I'm really focused on income. What I'm doing is I'm using this income in order to pay down my debts, in order to really build up this account. So I'm leaning more on the risky side, leaning more on more money up front. So that decision, I decided to sell off my NEOS positions and remain my positions in the Roundhill. So let me rebalance this here. So my largest positions are still XCT, QDT, MAGI, YBTC, and I still have some ULTI. As you can see, here are the percentages of these positions. XCT, I'm still recovering out of that. I'm only down 1.9%. QDT, I'm up 1.27. MAGI up 0.27. YBTC really got beat up because I kind of bought into it high, but with a bull run on Bitcoin, I foresee this coming up as well. And ULTI, everybody knows how ULTI is. It kind of flaps around, but it pays consistently every single week. Now, we're going to keep an eye on ULTI, folks. I don't think it's a set it or forget it. At one point, if you've seen my earlier videos, I had like 40,000 shares of this stuff. This is when I was kind of being a little greedy and being a little bit foolish, I think. But anyway, so these are my positions. So I have this dividend tracker. If you guys are new, I have a video on how you can build your own tracker. It's absolutely free, so check out that video. It's on my channel. But anyways, this was my original portfolio here. I just have a breakdown, and let me see if I can zoom in for you guys. Okay, so as you can see here, this was my original portfolio. You can see the amount of shares here and the dividend amount. So if that was calculated, that I would be making 156, a little bit over $156,000. And my margin on holding this position would cost me about $12,500. Now you can see the balance here is 478, and this is considering that $250,000 would be of my own money. So if you do the math, basically this will tell you that I'll be carrying a margin of $228,000. Now this is great on a huge bull run, just like we've experienced in the past month. You obviously, like, by borrowing that 5% and making a 30% annual, obviously your portfolio would grow, and this is exactly what happened to my portfolio. I really risked it. I wanted to have more money up front, so I rolled the die on that. It happened to work out. Again, none of this financial advice, folks, but that margin costs $12,000. Now, the issue obviously is if we have a huge correction, let's say a 20% correction. Well, I would owe 20%. Well, my $250,000 will go down by 20%, and the money that I'm borrowing would then go down by 20% as well. So now, really, what would that look like? Well, if you say, let's say this position times 0.8, right? That would be a 20% correction. Well, now this account is down to 382, but you got to remember, I'm borrowing 228 on margin. So let me see if I can calculate that for you. So if you see, this would be a 20% correction, and I still owe them 228,284, right? That's what I have on margin. So if you take this and then you subtract that, what I owe them, then that means my account balance is now $154,000. So now I just lost, if we do the math here, on a 20% correction, I would lose $95,000 of my account. Okay, so that's a pretty hefty correction. Now, and really, if we look at like what happened from the peak of really the end of 2024 through the tariff announcement, if we look at S&P 500, we'll just look at year to date. We'll look at 1 year, right? So from this peak right here, we were at $6,144. Well, if you look from that peak all the way, riding that all the way to the bottom, I calculated this. This was a correction of 21%. Okay, so 21% correction. So really, I would lose even more money than the $95,000. Would be over 20%. So, and that is the scary part. Now, if you can write it out, obviously we've seen a very fast recovery. I mean, it only took just a month of sitting around waiting from February to really recover back in June. Well, really just a couple months of recovery. Now, if you look at some of the downturns we had, like 2008. Okay, that was July 20th, 2007. Let's say we were at like $1,500 a share of SPY. If you move this needle, at what point did we recover? Well, we recovered, let's see, February 22 of 2013. This took 5 years. This took like 5 years to recover. Okay, so can you stomach that for 5 years to recover that? Are you able to stomach losing $100,000 and recovering 5 years later? And that is obviously, this is, we're just looking at S&P 500. We don't have Bitcoin or gold or anything else mixed into this, but that was really my concern, right? So how do we reduce this risk? Now, in event of, let's say, a 50% correction, okay, we can do the math on that. So a 50% correction, this account Okay, so this will go down to $239,000. And I'm borrowing $228,000. So I would go from $250,000 account to a $10,000 account in a 50% correction. Okay. Yeah, that's pretty scary. And that's what happens when, obviously, when you have a huge correction and when you use other people's money. So there's obviously a risk behind this. So this isn't like free money and you just do whatever you want with it. You got to be smart, right? So what I did today is I unloaded SPY, I unloaded QQQI, I unloaded BTCI. I had a position in chat, which I've made 20% on chat, which is not on this one and doesn't pay any dividend, but I've unloaded that. And anyways, so what happened was I reduced my position now to $380,000. Okay, so now I have $248,000 of my own money, and we can just do the calculation here. So, and right now, if we go here, you can see what I'm borrowing. So right now I am borrowing, let's see, my margin requirement is $93,000 and I'm using $125,000 of margin. So I reduced my margin by almost half. Okay, $125,000 on margin. Okay, so this is on margin. Okay, now these numbers might not line up because of the values. So let's just look at here. What is my account represented? So if we have 100, let's see. Well, actually, I can just add it here. Okay, we'll just add it here. Sum of this plus this. Okay, so my account's actually $373,000 right now. Okay, so $373,000. Now let's say we have a 20% correction. And we're going to say 373 times 0.8. So my account will then go down to $298,000. And then I am borrowing this $125,000 from it. So minus that. So then my account will now be down to $173,000. And that means I would lose 248 minus 173. So my account will now reduce by $74,000 in a 20% correction. Whereas before, what did we say was, well, we have to undo all this math, but basically that was 0.8. So really it went from $154,000 loss to a $74,000 loss. So really I lowered my risk by half, and really that's what happens when you reduce your margin by half. So that is and we can calculate obviously a 50% correction. 50% correction, I'd be down 100, so I'll be down to $186,000, and then I'm borrowing on margin $125,000. So my account will be down to $61,000 as opposed to $10,000, right? That's on a 50% correction, which is still quite a bit. But like I said, chances are of a 50% correction. I mean, it does happen, but it's not as often. And again, I am a little bit more bullish on the market. But folks, we are at a high, all-time high, and this is one of the reasons that I wanted to really de-risk today. I thought that today would have been a good opportunity to do that, especially with the government being shut down. No major news as of right now. So that's what I got. So with this reduced account, as you can see, my income reduced down to $135,000, which if we do a 12 per month, so that would be down to $11,000 per month. Whereas before this was probably like $12,000, right? This was $12,000. So I lowered my risk and my income only dropped like $700 a month. Okay, so I think that's quite worth it. Now again, the payers that I have, they do pay out more, so in a correction they won't recover as much. But that's really in the details, and that's part of the game. So didn't mean to make this video extremely lengthy, folks, but I think this was very important to cover, and I think that might answer a lot of questions folks had. Really, my next steps are to rebalance this portfolio to have a little bit more exposure to gold, more exposure to other assets that are outside of NASDAQ and S&P 500. So I hope you like this. If you did, please give me a thumbs up. If you have any questions, leave them below, and we'll see you on the next video. Thank you, folks.